Dear clients, welcome to PhillipCapital's Weekly Market Watch. My name is Weiwen. Today, I'll be sharing with you our US macro outlook as well as investment opportunities in the US asset space. The US economy is showing signs of a split personality. Households are increasing consumption while firms are delaying investments. Economic recovery is still sluggish at best. After the November elections, we expect some political gridlock over the fiscal cliff as well as the debt ceiling in view of a bipolar, dysfunctional Congress. But we do not expect the US economy to be dealt with a full-blown fiscal cliff. Looking ahead, market gyrations are likely the norm owing to constantly changing risk perception in view of unfolding political events as well as macro data releases. In such an environment, our key calls for the US market, which will perform well either in a risk-on or risk-off environment, are as follows. Investors can consider entering long positions in mortgage-backed securities. The Fed is going to buy this at the tune of US $40 billion per month indefinitely until there's substantial improvement in the labor market, which could take quite a while. High-yield US corporate bonds. US dollar portfolios are moving out of treasuries and investment-grade corporate to trudge further along the risk spectrum in search of yield. And third, treasury inflation-protected securities. Portfolios are loading up TIPS as inflation insurance in view of the open-ended nature of QE3. Fourth, dividend plays such as iShares Dow Jones Select Dividend Index Fund, and second, iShares S&P US Preferred Stock Index Fund, which offer relatively attractive yields of around 3.5% and 5.7% respectively. On the equities front, the S&P 500 is just a whisker away from its cycle high. We have equity index ETFs and CFDs available for the S&P 500, Dow Jones Industrial Average, and Nasdaq. Clients can tap on this to trade their market view. However, in view of the elevated uncertainties ahead arising from the looming fiscal cliff, as well as unresolved issues on the Eurozone front, markets are faltering and struggling to make new highs. For the rally to sustain, apart from asset reflation via central bank easing, we need to see an improvement in macro fundamentals and corporate earnings, which has been lackluster thus far. On balance, we are underweight US equities despite cheap valuations on the macro risks highlighted above. Within the equity space, we prefer first, healthcare, ticker XLV, as it is a defensive sector with high growth potential and broad-based demand. Second, financial, ticker XLF, should also benefit from increased mortgage lending on the back of a housing recovery and extremely low borrowing rates from the Fed. Third, home builders, XHB, ticker, in view of the firmer recovery in the housing market and rebuilding efforts in the aftermath of Hurricane Sandy. Fourth, we are neutral on technology, consumer staples, consumer discretionary, and energy. We have low conviction on utilities, industrials, materials. We have yet to see a significantly weaker US dollar notwithstanding the abundant global liquidity. Looking ahead, we expect the US dollar index to remain soft in the consolidation phase rather than outright steep decline. With MAS standing pat in October, we expect the Sing dollar to be strong against the US dollar. Consensus year-end estimate stands at 1.22. With that in mind, there's a likelihood of currency translation gains for our Singapore clients on top of capital gains to be reaped from their US investments. We encourage our clients to read our US Macro Asset Strategy Report dated 24th October for more details on our asset strategy as well as the wide array of ETFs and CFDs available that clients can tap on to trade the market outlook. That is all that we have for you today. Do stay tuned to next week's video. Thank you.